Hey guys, Mike here. So, whoa boy, man. I don't know if you saw Jerome Powell speak today, but you know what? He did what the market interprets as a Fed pivot. That is not a true Fed pivot. All right, just slowing down rate hikes. A true Fed pivot would be cutting rates, or even maybe if you want to go with not raising rates anymore. But again, the market wants what the market wants. And it's so funny. I'm going to show you a recording, like just the first couple minutes of the chart on the 1 minute versus him speaking and what happened. And then we're going to go into it's just a boatload of news that came out this morning. That's why the market was kind of just trading sideways up and down in a range until he spoke. But I'm telling you, man, to start us out with something funny, I swear this is the market embracing Jerome Powell. Like, thank you, we love you, thank you is what we've been waiting on. And you would have thought the man printed out money during that speech, guys. I'm telling you. But here's just the first 120 seconds of the speech lined up with the chart so you see what happens. My bet was as soon as he said hello, I told somebody in Discord, it's going to move in a 1% direction, up or down, right? I was totally wrong. They went ahead and did it during the intro.
On behalf of the Brookings Institution and the Hutchins Center on Fiscal and Monetary Policy, Jay Powell. Following his remarks, Mr. Powell will field questions from David Wessel, the director of the Hutchins Center, and from the audience. Jay, thank you for joining us.
Thank you, Glenn. It's great to be here today. It's great to be back at Brookings. So today I'm going to offer a progress report on the FOMC's efforts to restore price stability to the U.S. economy for the benefit of the American people. And that report must begin by acknowledging the reality that inflation remains far too high. My colleagues and I are acutely aware that high inflation is imposing significant hardship, straining budgets, and shrinking what paychecks will buy. This is especially painful for those least able to meet the higher costs of essentials like food, housing, and transportation. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
And as you can see, he didn't even speak yet. They were introducing him, so at 1:30, algorithms, the market makers, whoever, just kicked in and started sending it higher, right? And then as soon as he opened his mouth about inflation being high, you saw the reaction, okay? And then he kept going on. I recorded the whole thing, but it'd be too long for this. And all they were waiting for was just one phrase. The rest of it meant nothing. And it was, at some point in time, probably starting in December, we need to start slowing the rate of the hikes, right? Even though he emphasized the overall terminal rate, the end rate, is going to be higher than what we thought in September, which is not good for the economy at all or the stock market. They didn't care. All they were waiting for is that signal. They got it from other people. They were sitting there thinking it, and that was the confirmation that 50 basis points is pretty much guaranteed for the month of December, which starts tomorrow and just so happens to coincide with the last day of November to close out, actually higher than we did last month, right? And I'm going to show you, I've done videos on market makers, manipulation. I'm going to show you exactly what market makers can do, the power of algorithms, right? I mean, check this. And you can just see it right here, guys. I mean, we come up against, we get into that golden pocket I talked about. This is what I use for the golden pocket. There's different ranges for you. But, it says, I don't know, maybe yes, because this is where you get all the reversals. Nope, we're going higher. Boom, pushes through the resistance. Gets up to the 200. It's like, I don't know, no problem. Boom, moves up, and then look at this mess at the end right here. Look at that volume bar at the bottom. This way you can guarantee. Market maker said, the hell with the sell orders. They're going in the dart pool. The buy orders are being routed into the market, which pushes the stock through the roof, right? And then, of course, once it hit that edge of that downward trending channel, boom, it just exploded. And for a lot of you guys, one of my favorite clips to put out here, I'm sure it felt like this right here. And of course, for me, I thought, you know what? I wonder what smart money's doing, right? We talked about this yesterday with HYG, how they were doing higher lows, higher highs, going along with it. But you know what? They said, the hell with this. We going on a ride too, baby. So, yeah, that's my favorite clip of all time. But, I mean, that's pretty much what it was kind of like, right? But smart money went right along with it. And this is the thing I talked about in my video yesterday. I said, doesn't mean we can't have a good December when you look at the stats of bear markets versus all markets, right? And I actually went back and did the math. on the last 10 bear markets, there's only, I think it was a 40% chance they would be green in December if you're in a bear market, and versus it's 70% the other way. And then I was shocked to see, and I told you guys, you got to find like true bears, the people that are bears from the market, but actually tend to be correct along the way. Watch when they flip. Remember I talked to you about Mike Wilson flipping at Morgan Stanley right before this run up and what he said about December already. And then there's Dan Niles who flipped also before this run up. And then he put this tweet out yesterday, and I did verify this came from his Twitter account. So, and he has like 60-something thousand followers. So unless somebody hacked his actual account and did this, because he was so detailed, I was very surprised. And as far as I know, this to be true. I haven't seen any correction put out by him. And it says over the past 70 years, S&P has Thanksgiving turkey hangover on Monday and Tuesday of following week down 60% of the time, which it was. Then visions of sugar plums drive S&P up 74% of the time with average gain of 1.1% through Xmas. Based on recent data, he is going to buy positions in e-commerce or has bought, BNPL, which is buy now, pay later, to my understanding, oil and emerging market stocks. And so if you're looking where to go, now, does that guarantee a December? No, because like I said in yesterday's video, hey, the market's going to do what the market's going to do. And it don't matter what you want. You can go kicking and screaming or whatever. The market could reverse tomorrow, right? And you just don't know yet, okay? And so again, to break through all those in one day, to all that resistance in one day, that is amazing to see, especially at the top of the channel. That's amazing to see right there. And I have no doubt the market makers and algorithms had a whole lot to do with it, let me tell you. And so, we'll see where we go. Again, now what I'm going to do is get you back to reality just very fast, because a lot of data was released this morning and it didn't really affect the markets either way, okay? But this was some of what Jerome Powell talked about, and the market decided to ignore all of this because it wants to move higher. That's what it wants to do. And I want to start off with this, which came out the other day, and I've been meaning to tell you about this. This is the Federal Reserve's money supply M2 year-over-year percent change, right? You see all the money they put in the market, the percent change, and this is the money they took out of the market. It's ridiculous if you try to take just the year-over-year change, because by looking at this, you think, man, they must have taken all that money back out of the market, which is totally untrue. As you can see, it's way down there. You have to go back to like 1990s to be at that level or something, but that's ridiculous. What you really want to do, what I like to look at, is M2 with GDP, right? And this gives a better look. Like, that's where we're at. So you can kind of go, yeah, we really hadn't taken that anywhere near the amount of money we took out of the market, right? I mean, you see where we actually need to get if you're actually on just a trend line here. If this is a stock chart, well, that's what we need to get. That's way away. I don't even think we've reached that, for God's sakes. And then the other one was the PMI fell off a cliff, 37.2 versus 47. It was 45 the prior. And so, yeah, so basically reading through this, prices paid rose at a slower pace. New orders and production, which is the big one you want to look at, fell at a faster pace. Inventories rose at a faster pace, and employment fell at a slower pace. Shocker there. Talking about employment. That leads us to the ADP National Employment Report. And this one right here, they actually created less jobs than what they thought they were going to create. I think they thought like 200,000, and it came in 127,000. And so those rate hikes or something's having some kind of effect. But the big thing was they dropped 100,000, I believe it was in construction or something, in jobs, but it was hospitality at 224,000 jobs what made this look as positive as it was. We actually would have been negative, so keep that in mind for the future. And then you got job openings. Right here you can see, I mean, it's kind of just stuck right here. And right now, keep this in your head, there is still 1.7 jobs for every one person looking for a job. It was 2, so it is falling, but look at that. I mean, that is unbelievable to still see that. And if you're new here, please hit that subscribe button. Really appreciate it. And if you're getting anything out of this, please hit the like and think about sharing the video, guys. And so you can see employment is still, as Jerome Powell said today, it's tight, man. It's tight. People are still getting raises, right? We're still spending. We're still running up debt, all this other stuff, right? So economically, this is why you see, I'm talking about Bank of America, Citi, Morgan Stanley, JP Morgan, you name it. Like, they're all lined up to tell you, we're predicting a recession, right, in 2023. Maybe mild, maybe moderate. Probably going to be second quarter, somewhere in there. Somewhere in the middle of the year is what they're thinking. But what's holding it up, like every one of them say, and how many times have I said it, how many times other people said it? Employment. As long as we have jobs, you can run that debt up until the day is long. Doesn't matter. It just doesn't, right? And so, and that leads me to something, and this right here is a big one, because, like, I don't know, if you're like me, I'm thinking about 2023. Right, and I'm I make my list of stocks I want to be into and all this other stuff at these great prices, And there's something you got to be aware of if you're not aware of. And another thing when you talk about, especially when you're talking about people who are like, man, the market should be down farther because of the ratio and the price of sales ratio should be down to this because it was at this in 2018 and 20. Well, I'm going to show you exactly why we will probably never do that. And going by this ratio is going to leave you holding the bag somewhere. You're going to get left behind because unless something catastrophic happens, which the Fed usually does break something, but unless something catastrophic happens, we won't hit it. I'm going to show you something. So check this out. This came out just yesterday. Massive buybacks. Apple has spent an average of $50 billion per year on buybacks over the last decade. That was why we had this massive bull run. Look at 2022. They're almost to $100 billion. There's the $100 billion. They're almost there. More than they've ever bought before, right? And so if you ever wonder why Apple stock doesn't fall off a cliff like it's supposed to and why people say it goes as the market goes as Apple goes, this is why, right? You know how many shares that is? It's crazy. Look at this. Compare them to anybody else. 2013 ExxonMobil. Look how much more. Come down to 2020 through 2022. Look how much more stock they buy back than the next nearest competitor. Look at this. The closest rival. Apple, or Alphabet, excuse me. 58 billion? Oh no, Apple said, don't worry, 90 billion, baby, already. And the year ain't over yet. I'll guarantee they're going to buy some up in December too. But that is amazing how many shares they're retiring, and that leads us to this right here. This came out yesterday too, the S&P 500 index price to sales ratio during bottoms. Okay, this is for bottoms. See the bottom there in the dot-com bubble. See the bottom in 08. See the bottom in, 2018, 2020. And you see where we're at right now. And you can see right there, we're nowhere close to it. Matter of fact, we're going back up, right? And we're actually at the tops of 2020, 2019, and 2000. I guess it'd be 2000, yeah. And you can see where we're at right there. And the reason why I say this is because you got to keep in mind the numerator, which is the top number in this equation, is price, the share price, right? So if you're buying back stock at those levels, and these stocks are so heavily weighted in the indexes, I've showed you what Apple is multiple times, right? And all those FANG stocks are, how much they make up in the S&P than they've ever done before, and you're buying back that much stock, what does that do to your price? Well, it keeps your price up. It raises your price up. Can you imagine if they weren't buying any stock this year, where Apple stock price would be right now? But they're taking so many shares off the market. And I read a article about, it was in 2018, and it was about Wynn Resorts. They were buying back massive amounts of stock, and just by them buying back the amount of stock they bought back, it raised their price to earnings ratio by 18%, which is why you see some of these companies say these companies are overvalued. Well, it's hard to figure out the true value of them because some of these companies are buying so much stock back that it drives those metrics up compared to other companies who do not, or who don't buy at the scale that these companies do. And so that's what I'm saying. Price of sales, I think it's more as looking at how big the drop is, right? And so when you look at that chart right there, if we go back to it, you can see plain as day the drop we've had so far on price of sales from the bubble that burst, right? And then you compare that to dot-com bubble, which is actually a bigger drop. You compare it to 08 though, it looks identical to me. Look at that. That's about the same drop, right? And so am I saying we need to be, lower on price of sales? Probably so, but the one thing that's not being taken into consideration, remember, is, again, I showed you the chart. All these FANG stocks weren't those FANG stocks back in the dot-com bubble and 08 financial crisis. They were the leaders coming out of the 08 financial crisis and got the benefit. And then they started buying back massive amounts of stock from 2010 all the way up. And a lot of people are learning this now, why they went on this massive run. Well, there's so many companies that are weighted much less that they can't buy back the stock. They're still trying to turn a profit, let alone buy back stock, right? And so that's what you got to take into consideration when you're looking at those. I'm just pointing that out. I'm not saying where the price of sale should be lower. Sure, no doubt about that. But make sure I'm not being confused on that. I just think you should look at that and say, so when you're making your list, that's what I really want to talk about. For next year, you're looking at it now like I am, you're trying to figure out what's overvalued, what's undervalued. First of all, it's almost impossible to figure out the earnings for next year because the companies don't even know. Most of them have pulled their guidance. You've seen on the earnings call, what are they doing? Changing all the time. Okay, we'll keep it for this year. We don't know the first quarter. They don't know what to guide for, right? So it's almost impossible to value these companies. For me, what I'm doing is looking at charts. I'll be honest with you, I've done so much research on this, looking at charts and, where's the mean and all this stuff like that with these lines. And it almost serves pretty well. And I do want to tell you, if you look at the QQQ, for example, or the NASDAQ, whatever one you look at, I'm telling you, you got to look at it because understand they're talking about a new bull run or a new bull market and all that stuff. But if you look, we're still in the channel. I mean, look right here. You can see, even though we basically dropped back down into the channel that we've been in for years. And so, again, the market's going to do what it wants to do. And what you could see happen more realistically is the market, if it pushes through tomorrow and going into December, right, and widens the downtrend, of course, you can see it push up, and then we go into recession, and then boom, everything falls off cliff. That's what you could see. There's no ifs, ands, or buts about it. I mean, that's what could happen. Again, even Jerome Powell said today, which kind of surprised me, he said, yeah, all these forecasts you're seeing, I wouldn't depend on them. Like, I think he's finally kind of just threw it in the towel and said, yeah, our forecast, nothing prepared us for this. There's no books. I've said it, how many months have I been saying that? There's no textbooks to help them. No textbooks. And so when he said that, I was like, wow. I mean, that it really is a guessing game. That's why you don't see me coming here saying, this is where we're going, and I tell you to run from everybody that does, right? Because they're idiots. There's no way they know that, for sure. There's no way, right? Everybody's going to get it, right once in a while. I mean, even what's the saying? A blind squirrel finds an acorn every once in a blue moon or something. And so our broken clock is right twice a day or whatever it is. And so, that's just kind of how you got to go. Be quick, be nimble, be making your list and all that stuff and checking it twice because we're coming into December tomorrow, baby. So starting a new month, which is a whole another thing to talk about. But anyway, hope you got something out of it. Let me know in the comments what you're doing, what you think is going to happen in December. Always like to hear from you guys. And I'll see you tomorrow.